Owning a home is a big investment, and it comes with a lot of expenses. But did you know that many of those expenses can save you money on your taxes? That's right, homeowners can claim a variety of deductions to reduce their tax burden. In this video, we'll break down the most common homeowner tax deductions, so you can maximize your refund. The mortgage interest deduction is a significant tax benefit for homeowners. Essentially, it allows you to reduce your taxable income by the amount of interest you pay on your home mortgage. This deduction can provide substantial savings, especially in the early years of your mortgage when the interest portion of your payments is higher. To qualify for the mortgage interest deduction, the loan must be secured by your primary residence or a second home. Additionally, the deduction is generally limited to interest paid on the first $750,000 of mortgage debt for married couples filing jointly, or $375,000 for single taxpayers. It's important to note that these limits apply to loans acquired after December 15, 2017. Loans originating before this date may have different qualification rules. To claim the mortgage interest deduction, you must itemize your deductions on your tax return rather than taking the standard deduction. This means that your total itemized deductions must exceed the standard deduction amount for your filing status. That's essential to keep accurate records of your mortgage interest payments throughout the year. Your lender will typically provide you with a mortgage interest statement, Form 1098, which details the interest paid during the previous year. This form is crucial for completing your tax return accurately. While the mortgage interest deduction offers substantial tax savings, it's essential to consider the overall financial implications of your mortgage. Factors such as interest rates, loan terms, and your financial situation should be carefully evaluated when making mortgage decisions. Additionally, tax laws are subject to change, so it's advisable to consult with a tax professional for personalized guidance. Property taxes represent a substantial expense for homeowners. Fortunately, these payments can often be deducted from your federal income tax return. This deduction is a valuable tool for reducing your overall tax liability. To claim the property tax deduction, you typically itemize your deductions rather than taking the standard deduction. Itemizing allows you to list specific expenses, including property taxes. If your itemized deductions exceed the standard deduction amount, you'll benefit from claiming property taxes. It's important to note that the amount of property taxes you can deduct is generally limited to those paid within the tax year. Be sure to keep accurate records of your property tax payments, including receipts or statements. While property taxes are generally deductible, there are some nuances. State and local governments may impose limitations or caps on the amount of property taxes that can be deducted for state income tax purposes. Additionally, certain tax laws and regulations might affect the deductibility of property taxes in specific circumstances. Understanding the intricacies of property tax deductions can be complex. If you have questions or concerns about claiming this deduction, consulting with a tax professional is advisable. They can provide tailored guidance based on your specific financial situation and help you maximize your tax savings. If you're fortunate enough to have a dedicated workspace within your home, you might be eligible for a valuable tax deduction. The home office deduction allows you to deduct a portion of your home's expenses, such as mortgage interest, property taxes, utilities, and homeowners insurance, based on the square footage of your home office relative to the total square footage of your home. However, qualifying for the home office deduction isn't straightforward. The IRS has strict criteria that must be met. Your home office must be used exclusively and regularly for business purposes. This means it can't double as a guest room or hobby space. Additionally, your home office must be your principal place of business or a meeting place with clients, customers, or patients. There are two methods to calculate the home office deduction: the simplified method and the regular method. The simplified method is generally easier but offers a smaller deduction. It allows you to deduct $5 per square foot of your home office, up to a maximum of 300 square feet. The regular method involves more detailed calculations but potentially provides a larger deduction. It requires you to calculate the ratio of your home office square footage to the total square footage of your home and apply that ratio to your eligible home expenses. It's essential to maintain meticulous records of your home office expenses. This includes documentation of business income, expenses, and the exclusive use of the space for business purposes. The IRS can request this information during an audit, so it's crucial to have organized records readily available. While the home office deduction can be a significant tax saver, it's important to weigh the potential benefits against the time and effort required to maintain accurate records and meet the IRS's strict guidelines. Consulting with a tax professional can help you determine if claiming the home office deduction is worthwhile for your specific situation. When securing a mortgage, you'll often encounter two additional costs: points and loan origination fees. While these expenses might seem like added burdens, understanding their tax implications can soften the financial blow. Points are essentially prepaid interest. When you pay points, you're essentially paying a portion of your mortgage interest upfront. In exchange, you often receive a lower interest rate on your loan. The good news is that points are generally tax deductible in the year they are paid. However, there are specific rules. You can typically deduct points if the loan is secured by your primary residence. The points are paid to reduce the interest rate on the loan, and the points are customary in your area for loans of that type. Loan origination fees, on the other hand, cover the lender's administrative costs for processing your mortgage application. These fees are typically not tax deductible. However, there might be exceptions depending on specific circumstances and the nature of the fees. It's essential to consult with a tax professional to determine if your loan origination fees qualify for a deduction. It's crucial to remember that even if points or loan origination fees are deductible, they might be subject to certain limitations or phase-outs based on your income and other factors. Additionally, tax laws can change, so it's always advisable to consult with a tax professional for the most accurate and up-to-date information. By understanding the tax implications of points and loan origination fees, you can make informed decisions when securing a mortgage and potentially maximize your tax savings. Making your home more energy efficient not only benefits the environment but can also provide significant tax advantages. The federal government offers tax credits for homeowners who install specific energy-efficient improvements. These credits can help offset the cost of your upgrades and provide substantial savings. One of the most popular energy-efficient improvements eligible for tax credits is the installation of solar panels. These panels convert sunlight into electricity, reducing your reliance on traditional power sources. The federal government offers a tax credit for a portion of the cost of installing solar panels. It's essential to check the specific credit amount and eligibility requirements as they can change annually. Beyond solar panels, other energy-efficient improvements may qualify for tax credits. These can include insulation, energy-efficient windows, and geothermal heat pumps. These upgrades not only reduce your energy consumption but also contribute to a smaller environmental footprint. It's crucial to note that the availability and amount of tax credits for energy-efficient home improvements can vary. Tax laws are subject to change, so it's essential to stay informed about the latest updates and consult with a tax professional to determine your eligibility and maximize your potential savings. By investing in energy-efficient upgrades and taking advantage of available tax credits, homeowners can enjoy long-term cost savings, reduce their carbon footprint, and potentially receive a substantial tax refund. While the deductions we've covered thus far are the most common for homeowners, several other potential tax breaks might apply to your specific situation. It's essential to delve deeper into your finances and consult with a tax professional to identify all possible deductions. One potential deduction is private mortgage insurance, PMI. If you made a down payment of less than 20% on your home, you likely paid PMI to protect the lender. In some cases, you may be able to deduct the PMI premiums. However, the rules for deducting PMI can be complex, so it's crucial to check the specific tax guidelines. Another potential deduction is casualty losses. If your home suffered damage from a sudden, unexpected, and significant event like a fire, storm, or theft, you might be eligible to deduct the loss. To claim this deduction, the loss typically must exceed a certain threshold, and you'll need to provide documentation of the damage and losses. For homeowners who itemize their deductions, state and local income taxes paid during the year can be included. This deduction can offset your federal income tax liability. However, it's important to note that the Tax Cuts and Jobs Act placed limitations on state and local tax deductions, so it's essential to understand the current rules. Remember, tax laws can be intricate, and the availability of these deductions may vary based on your specific circumstances. To ensure you're taking advantage of all eligible deductions, consider consulting with a tax professional who can provide tailored advice based on your financial situation. Maximizing your homeowner tax deductions can significantly impact your bottom line. Remember to keep detailed records of your expenses throughout the year. And while we've covered the basics, tax laws can be complex, so it's always a good idea to consult with a tax professional for personalized advice. If you found this video helpful, please like, share, and subscribe to our channel for more financial tips. Don't forget to leave your questions and comments below.